Earnings per share, or EPS, is one of the most fundamental metrics used by investors to assess a company's profitability on a per-share basis. It represents how much profit a company generates for each outstanding share of its common stock, giving investors a clear indicator of financial performance relative to ownership. Unlike total net income, which can be misleading for companies with vastly different numbers of shares, EPS normalizes profit across share count, allowing for fair comparisons between firms. Calculating EPS is straightforward. You take the company's net income, subtract any preferred dividends, and divide the result by the weighted average number of common shares outstanding during the reporting period. This metric is reported quarterly and annually in financial statements, making it easily accessible for analysis. Investors rely on EPS not only to gauge current profitability but also to forecast future earnings potential, which directly influences stock valuation. A consistently rising EPS often signals strong management, operational efficiency, and market demand for the company's products or services. Conversely, declining or volatile EPS can indicate underlying business problems, competitive pressures, or poor capital allocation. For value investors, EPS serves as a critical starting point. It's not the only metric that matters, but it's impossible to ignore. Understanding EPS is the first step toward decoding a company's true financial health and determining whether its stock is undervalued or overvalued relative to its earnings power. In value investing, the goal is to identify stocks trading below their intrinsic value, essentially buying dollars for 50 cents. EPS plays a central role in this process because it directly feeds into valuation ratios like the price-to-earnings ratio, which compares a stock's market price to its earnings per share. A low price-to-earnings ratio may suggest a stock is undervalued, but without understanding the quality and sustainability of the EPS behind it, that conclusion can be dangerously misleading. Value investors don't just look at the headline EPS number. They dig into its components. Was the profit driven by core operations or one-time events? Were share buybacks used to artificially inflate EPS? Is the company reinvesting enough to sustain future growth? These questions matter because temporary or manipulated EPS can create illusions of value where none exists. Benjamin Graham, the father of value investing, emphasized the importance of normalized earnings, smoothing out cyclical or irregular profits to reveal a company's true earning power. Modern value investors follow this principle by analyzing EPS trends over multiple years, not just the latest quarter. A company with stable, growing EPS over a full business cycle is far more attractive than one with erratic spikes. EPS also helps investors compare companies within the same industry, adjusting for size and capital structure. Ultimately, EPS is not an end in itself. It's a tool to measure economic reality, and value investors use it to separate superficial performance from durable, compounding businesses. There are two primary ways EPS is reported: basic EPS and diluted EPS, and understanding the difference is essential for accurate analysis. Basic EPS is calculated by taking net income minus preferred dividends, divided by the weighted average number of common shares outstanding during the period. It's the simplest form and reflects earnings available to existing common shareholders. Diluted EPS, however, accounts for all potential shares that could be created if convertible securities, such as stock options, warrants, or convertible bonds, were exercised. This provides a more conservative, worst-case scenario of earnings per share, assuming all possible dilution occurs. Investors should always prioritize diluted EPS when evaluating a company, especially in industries like tech or biotech where employee stock options are common. A large gap between basic and diluted EPS can be a red flag. It suggests significant potential dilution, which erodes shareholder value over time. Additionally, companies may report adjusted EPS or non-GAAP EPS, which excludes certain expenses or gains to present a cleaner picture. While sometimes useful, these adjusted figures can be manipulated to hide poor performance. Always cross-check them against GAAP-compliant numbers. Also, be cautious of companies that aggressively buy back shares to boost EPS without improving underlying profitability. This is financial engineering, not real growth. Finally, ensure you're using the correct share count, weighted average shares, not shares at period end, to avoid distorting the metric. Precision in calculation leads to precision in judgment. A single quarter's EPS figure tells you very little. What matters is the trend over time and the quality of earnings behind it. Investors should examine at least 5 to 10 years of EPS data to identify patterns. Is EPS growing steadily? Is it volatile? Is growth accelerating or decelerating? Consistent, predictable EPS growth is a hallmark of high-quality businesses with durable competitive advantages. On the other hand, erratic EPS, swinging wildly due to commodity prices, regulatory changes, or accounting adjustments, signals higher risk and lower predictability. Beyond the trend, the source of earnings is critical. Did EPS grow because the company increased sales and margins, or because it cut R&D, delayed maintenance, or sold off assets? Sustainable EPS growth comes from operational excellence, not financial gimmicks. Look at cash flow from operations. If EPS is rising but cash flow isn't, the earnings may be soft or even fictitious. Also, compare EPS growth to revenue growth. If EPS is growing much faster than revenue, it could mean the company is leveraging cost cuts or financial leverage, which may not be sustainable long-term. High-quality EPS is backed by real cash generation, low debt, and reinvestment in the business. Avoid companies that rely on aggressive accounting, frequent one-time adjustments, or unsustainable buybacks to prop up EPS. Remember, in value investing, consistency and durability trump short-term spikes. A company that grows EPS by 8% annually for 10 years is more valuable than one that grows 30% for 2 years and then collapses. Quality compounds, illusions evaporate. EPS alone is meaningless without context. You must compare it against peers, industry averages, and historical performance to derive real insight. A $5 EPS might seem impressive, but if the industry average is $10 and competitors are growing at 15% annually, that company is lagging. Conversely, a $1 EPS might look weak, but if it's in a capital-intensive industry with high barriers to entry and the company is gaining market share, it could be undervalued. Always benchmark EPS growth rates, margins, and return on equity within the same sector. Comparing a software company's EPS to a utilities is apples to oranges. Sector-specific dynamics matter. Tech companies often reinvest heavily, leading to lower current EPS but higher future potential. Consumer staples may show slower EPS growth but with extreme stability. Also, consider the economic cycle. Cyclical industries like automotive or construction will have volatile EPS tied to GDP growth, while defensive sectors like healthcare or utilities offer smoother trajectories. When comparing, use trailing 12-month EPS for consistency and adjust for currency or accounting differences if analyzing international firms. Don't forget market cap. A small-cap company growing EPS at 20% is very different from a mega-cap doing the same. Scalability and market saturation affect sustainability. Use tools like Bloomberg, Morningstar, or even free platforms like Yahoo Finance to pull peer comparisons. Context transforms raw data into actionable intelligence. Never analyze EPS in isolation. The goal is relative value. Which company delivers the best earnings power for the price within its competitive landscape? At its core, a stock's price is a reflection of the market's expectations for future earnings, and EPS is the unit of measurement for those expectations. When a company reports higher than expected EPS, its stock typically rises. When it misses, the stock often falls. But value investors don't chase quarterly surprises. They focus on long-term earnings power and whether the current stock price adequately reflects it. The most common valuation tool tied to EPS is the price-to-earnings ratio, price divided by earnings per share. A price-to-earnings of 15 means investors are paying $15 for every $1 of annual earnings. But price-to-earnings is only useful when combined with growth. That's why the PEG ratio, price-to-earnings divided by EPS growth rate, is often more revealing. A low price-to-earnings with stagnant EPS may signal a value trap. A high price-to-earnings with rapidly growing EPS may still be undervalued. Also, consider forward EPS, analysts' estimates for next year's earnings versus trailing EPS. Forward EPS drives market sentiment, but it's speculative. Trailing EPS is fact. Value investors anchor themselves in trailing, normalized EPS and apply conservative growth assumptions. Another key concept, earnings yield. which is the inverse of price to earnings, EPS divided by price. A 6.7% earnings yield, price to earnings of 15, may seem attractive compared to bond yields, but only if those earnings are reliable and growing. Don't ignore interest rates. When rates rise, high price to earnings stocks become less attractive because future earnings are discounted more heavily. Always ask, what multiple of EPS am I paying, and is that multiple justified by the company's growth, risk, and return on capital? Valuation is not math, it's judgment. EPS gives you the inputs. Your job is to apply rational, long-term thinking to price them correctly. Despite its importance, EPS has significant limitations, and investors who rely on it blindly will make costly mistakes. First, EPS ignores capital structure. Two companies with identical EPS may have vastly different debt levels, meaning one is far riskier than the other. A highly leveraged company can show strong EPS until interest rates rise or revenues dip. Then, the debt burden crushes profitability. Second, EPS says nothing about cash flow. A company can report high EPS while bleeding cash, common in businesses that extend generous credit terms or carry heavy inventory. Always cross-reference EPS with operating cash flow per share. Third, EPS doesn't account for asset efficiency or return on invested capital. A company may grow EPS by pouring money into low-return projects, value-destructive growth that inflates earnings but destroys shareholder wealth. Fourth, accounting rules allow significant discretion in revenue recognition, expense timing, and reserve adjustments, meaning EPS can be smoothed, delayed, or accelerated to meet targets. Watch for frequent non-recurring items. If they recur every year, they're not non-recurring. Fifth, EPS ignores qualitative factors. Management quality, brand strength, innovation pipeline, regulatory risk. A company with flat EPS but a breakthrough product may be worth far more than one with rising EPS but declining market relevance. Sixth, international differences in accounting standards, GAAP versus IFRS, can distort cross-border EPS comparisons. Finally, inflation can artificially inflate nominal EPS without real growth in purchasing power. Always consider real, inflation-adjusted earnings trends. EPS is a vital metric, but it's one piece of a much larger puzzle. Wise investors use it as a starting point, never as the final word. To use EPS effectively as a value investor, you must integrate it into a disciplined, multi-step analytical process, not treat it as a standalone signal. Start by gathering at least 10 years of historical EPS data for your target company and its main competitors. Plot the trend. Is it stable, growing, or erratic? Calculate the compound annual growth rate and compare it to industry averages. Next, examine the quality. Compare EPS to free cash flow per share. Are they aligned? If not, dig into the cash flow statement to find out why. Then, look at diluted EPS versus basic. How much potential dilution exists? Review the footnotes in financial statements for explanations of adjustments, one-time items, or changes in accounting policy. Calculate valuation metrics, price to earnings, PEG, earnings yield, and compare them to historical averages and peer group medians. Apply conservative forward EPS estimates. Don't rely on Wall Street's optimism. Build your own model based on realistic growth assumptions. Stress test your EPS projections. What happens if growth slows by 50%? What if margins compress? How much debt can the company handle before EPS collapses? Only after this rigorous analysis should you consider buying, and only if the current price offers a sufficient margin of safety relative to your intrinsic value estimate. Revisit your EPS analysis quarterly, but don't overreact to short-term fluctuations. Focus on the long-term trajectory. Finally, combine EPS with other key metrics: return on equity, debt to equity, gross margins, and management's capital allocation record. EPS is your compass, not your map. Used wisely, it guides you toward durable, undervalued businesses. Used poorly, it leads you into traps disguised as bargains. Master EPS, but never let it master you. If you found this breakdown of earnings per share useful, make sure to like this video, subscribe to the channel for more deep dive analyses on value investing fundamentals, and hit the bell so you never miss an update. Drop a comment below. What's the next financial metric you want us to break down? ROIC, free cash flow, Piotrowski F-score? Let us know. Your suggestion might be our next video. And if you're serious about becoming a better investor, download our free checklist, 10 EPS red flags every value investor must know. Link in the description. Thanks for watching, and remember, in investing, understanding the numbers is just the beginning. Mastering their meaning is what builds real wealth.